Hi, this is Randy Finney with the right side of the chart, and this is a mid-session update for Monday, January 24th, 2022. I want to do one more update. I already got some stuff out to you on the broad market. Nothing there has changed, so I'll just do a very brief update and then go over the rest of the places to make money right now. This is QQQ. We hit my first target. We had a little momentum fueled overshoot. Remember, that's not only perfectly normal, but almost to be expected when you're in a waterfall type selling. And so, again, this is a weekly chart. So I give you 60-minute charts, active trader stuff, hone in your entries, exits, daily charts, kind of more of the realm of the typical swing trader, longer term investor, trend trader, and then, of course, the weekly charts. And just want to reiterate, this is a pretty good support, and I put a pretty high probability that we'll bounce off this level again intraday. Doesn't really matter. We'll see how we close the week. Now, I don't expect much of a bounce, but it's hard to really say how much. Let's see what happens this week. As I said, the Fed usually, the market tends to go in a holding pattern right before the Fed. So this could be it for the week here until Wednesday, and that's probably when the fireworks will resume, whether it's a initial pop up down, and I'll keep you posted. But I've already given you bounce targets today. If you're looking to trade, it was what 3% when I got it out to you, and we were towards the top of my first my daily swing target zone. Remember, we've had this one here for a while. We went on to hit the bottom of the zone. So that just means if you bought at the top or scaled in or waited till we hit the bottom, either way, now you're talking about a 4% bounce if we get a backfill the gap. Actually, almost more, almost close to 5 from today's low, right off the bottom of that first target zone on the daily if we do backfill the gap. So trade it as you want. And again, if you are not an active trader, you don't have the time. Maybe you're listening to this video today after you got home from work because you had to work all day and you didn't have time to make any changes. I think the odds, based on what's happening over the last couple weeks, especially the last week or so, increases the odds that will go on to hit at least my second target, if not more. So trade it as you want, but these are some pretty good sell signals. And again, nothing goes down forever. I talked about how oversold we are. The fact that it's the initial tag of the first target, and that's that itself, increases the odds. On SPY, I had a more of a target range. The first target really was at 426.32, but I had one close below it at 415.51. That's still good support there. And there's a SPY. It's below its 40-week moving average, but not too far. If it comes in, does make a backfill the gap, it's going to get right back up to that 200-day slash 40-week exponential moving average there. So, and then finally, although I favor a reaction here, we are in that what I call, we have that WTF moment for the dip buyers, or that point of recognition moment. I think it happened when we took out that about 451 level right there. The selling has been strong. And more importantly, I just want to loop back to things that I've talked about now for the last few months, and that includes the potential for a market crash. That's all those hurricane, tornado warning versus watch versus warning, and everything I've covered in recent months, including the SKU index, which is similar to the VIX. It's based on put and calls. And it's a crash indicator, and one that's been around a while, and that was flashing signals that we hadn't seen before as well. So, okay, what does all that mean? Well, look, we could just blast right on through most sports and go on down and have hit these deeper targets on SPY. I think I told you before I'd have to give you another intermediate term target there. I'll just throw it on right there, roughly about there. But QQQ, ultimately increases the odds of these next targets getting hit, T2 and T3 down here in the uptrend line, and I think that's where we're going to go before all said and done. Could be faster or slower. And then remember as well, I talk about this all the time, one reason I love to short stocks and one reason I warn of these big drops, whether or not they always happen. They don't always happen, but when they do, and this is something I said over and over again, stocks tend to fall a lot faster than they rise. So in just about a month now, we've wiped out 7 months of gains in the NASDAQ 100. 7 months of gains wiped out in a matter of weeks. And that's normal. That's what happens. almost every single time you have a correction and or bear market. Bear markets can wipe out years of gains in a matter of months, and corrections wipe out months of gains usually in a matter of weeks. So that's it. That's where we're at. Trade as you want. Just know that we are at support so far, holding right around that level. Well, you guys know what I think is probably going to happen, and trade it as you want. And again, if you're just don't, if you're the one getting home at 6 o'clock, 7 o'clock tonight watching this video, just, lower your stops to protect your profits to anywhere I talked about earlier, and let it run. But you will just know that riding out counter trend bounces during a correction, especially when volatility is high, on paper is going to be painful, especially if you're all in short. You have a pretty heavy short position, because those bounces are going to be measured in the usually in the high single digits, sometimes even low double digits in percentages. But if holding out for the big payoff, then you can do that, or an active trader can game the bounces. All right, let's not spend much more time on that. Let's just finally do an update on the small caps, because I still like those. And we're halfway there now, roughly halfway to my target. And look, this is, if I were to give an intermediate target, see any support, it's right here. There's not a lot, because remember, the reason I've had such an aggressive, just really one target, is that huge, I talked about it, ginormous thin zone right there. You don't see it here, but I have big volume price histogram bars in this trading range, and everything I talked about, coiled spring, energy, well-defined level, and mainly that this rip was similar, if you will, to a gap. It wasn't a gap, but it was a unidirectional run with very little volume after that massive breakout right there, and it'll act similar to a gap on the way down. So this is probably our main, our initial stopping point, and then something like this. And again, if things get ugly and those crash warnings or indicators that they're elevated, and everything else I've covered, super low put to call ratio for an extended period of time, and sentiment and everything else, that's possible. But I'd put that at, let's say, I hate to pick numbers, I'm just going to round it off, 7% that we just go on through there and do all that. That gives you better than 90% that we're going to bounce here soon off my numbers. And so that's these targets. So that's where I'm at. All right, let me get to everything else that is trade ideas. I'm going to start with crude, and I'm going to say this, that okay, we've already milked a pretty good portion now on the short side. And if we bounce, risk asset bounces as risk on assets as a whole should bounce. What are risk on assets? Well, crude oil, certain commodities that trade with the market, things like that, and risk off assets are treasury bonds and all that. So probably not a bad time to take, if I'm right, you can take some profits on ZB if you didn't do so. I took some profits on Friday on ZB, I think it was, last week. Where's that? I'm going to go to that. That's your 10-year treasury bond, but it's still in an uptrend. And here's a minor uptrend line. So if you want to just hold tight, if you like to hold and don't like to trade in and out, TLT is your ETF. There's also I think a 2-time leveraged one for the 30-year bond. But that's it. We're moving up. We're coming off that divergent low right there. Everything we had the breakout, went out last week. There is a little reaction high there that we're just up against. So although my target here, initial swing target, and that's all I really wanted out of that one initially. Again, I took profits just to kind of lighten up. But 157.094 is still a likely target. It's just a matter of, we're going to have a pullback here. If the market rallies, you may see a little weakness in treasuries if we do get a bounce in the market, and then another leg up. Maybe we even come all the way down there. I don't know. But again, probably not a bad time to book some profits there, or like I said, let it ride. There's some levels that should contain a pullback, at least that 157.200, maybe that uptrend line right there. It's pretty well defined. But let me get to the risk on assets, because this is where I think you can start to roll some of the profits from your index shorts into, especially after a bounce. Crude, I like crude. Crude, you need to watch it. There's a little bit of potential divergence if it can hold up here, but it did break down. Most recent updates, I gave you the primary uptrend line here on this 60-minute chart with a secondary minor trend line right there. That was broke last week. Probably have to pull it in tighter for you to see it in the video, which we'll do right there. So there was sell signal 1, and we hit the primary trend line after breaking down, bounced between the two, back testing the minor trend line from below, and then you got a secondary or second sell signal right there. Took you down to that first target slash support 83.25. We bounced off the initial tag of that level, and we've taken it out. We could be flagging here too. Little bit above it right now, but again, crude's gonna trade a little sloppily through that level. So if we get a bounce in the markets and crude bounces with it, which it probably will, most likely, maybe look to see we might have a trend line coming off the highs, roughly about right there. In other words, any strength now into crude, I think you can add to that short position. And the thing about crude is, and this is why I'm doing this video, is you get more bang for your buck. Or I'm sorry, let me clarify what I was trying to say. You should be able to get more bang for your buck on a short crude dollar for dollar. You also have to beta adjust. What do I mean by what I just said? Well, okay, crude oil is one single security. It's one single commodity. And when you trade the indexes, you can go a lot heavier with your short positions, or I do, because you're short a basket in the Nasdaq 100 of 100 companies in different industries. Given most of those are tech, but either way, S&P 500, 500 companies, 11 different sectors, many subsectors within there, broad diversification. So you're not going to get wiped out on any one single news event for any one of those companies. Whereas crude, yeah, one single thing. I know what's going on over there right now in Ukraine and Russia and all that, and that's buy crude, buy crude. It's gonna. I'm a believer of the charts. And I've been, I still think this one's poised for a major drop, just like the stock market was, with the divergences building, and finally those divergences in the market have started to play out. Crude, same thing. We've twice taken out that resistance right there, but we're right about where we were, just a marginal new high now. And again, this is that minor. Well, let me use this arrow tool. This little uptrend line here, if I were to draw it just like that little one there, that's the one we just broke on the 60-minute time frame. So if that plays out and we get another leg down, we take out, especially if we have a solid move back down through that level about 78, that's going to bring us down, have some pretty aggressive downside targets. In other words, I think this, in percentage terms, crude will likely fall more. It's not exclusively, but largely contingent on my call for the equity market being correct, and the fact that we're going to continue down in the coming weeks, despite any near-term bounces or counter-trend rallies anytime soon. That we're going to go on to hit at least my second, if not third and fourth targets on the equity markets. If that happens, I think the headlines, the prospects for slowing economic growth, as indicated by a falling stock market, are going to supersede any tensions or fears over what's going on in Europe right now. So either way, and again, an important thing, it's only one of many trades. You diversify. All your eggs aren't in one basket. On crude, you're going to beta adjust that down. You don't need to put a lot of money in something that can fall 30-40% in a month. Because that's what crude could do. It's more volatile than the market. So you take a smaller position, just like Bitcoin. Those trades, they fell through support, but they were small. That was about as small a position as you're going to take, because that's speculative. In very high beta. Beta is just basically, when I refer to that term, it can be used in different ways. It's how much something's going to go up against something else. They usually use a beta 1.0 for most stocks, is measured to the S&P 500. Means it's perfectly correlated and expects to go up. If the stock market goes up 3%, that security should go up 3, and stock market goes down 3, it goes down 3. Something like crypto has a beta. It's not even correlated directly with the stock market, but if you look at just the amount of percentage gains during the trends and day to day, then the beta is many times the S&P 500. So that's why I talk about beta adjusting. Just keep your position size commensurate with the amount of gain and loss potential, because those two go hand in hand. That's about one of the few constants on the market, is risk and return go hand in hand. So there it is. One of my favorites right now. But again, if the market bounces, that may give a little more upside to crude, and also it's still kind of hanging in there again with what's going on those concerns overseas. Where's my CL chart? There it is right there. And like I said, I'd be remiss not to point that out. So who knows? Maybe that could, maybe bombs start flying over there and you get another surge up. So like anything else, keep an eye on it. And what you want to see to maybe add to a position is these divergences get burned through, negated, taken out. In other words, we drop down through there, take out the previous lows and indicators, and you no longer have positive divergence. And but most importantly, we're on a sell signal. That sell signal is intact until and unless these recent highs get taken out. Crude remains on a sell. Alrighty, moving on to the next one where there's just, it's been a great short so far. This time around, we've been kind of hit or miss, caught some big trends in the past on lumber, had some sell signals and buy signals in recent months, some that played out and some that didn't. But the most recent one was right here, highlighted. You had this beautiful bearish rising wedge. We're on the hourly, no, we're on a 2-hour, 120-minute chart, 6 months. Same thing could be replicated on the hourly chart. And that bearish rising wedge was confirmed with negative divergence. We broke down, and in typical lumber fashion, it didn't look back. Lumber has really two directions, up and down. There's hardly any sideways. This thing's either going up or it's going down, up or down. And so since the sell signal, it's been a drop of about 15% or so. We're at that 1100, 1101 target right now. It is support. We could bounce, but again, the nature of this beast, that's a pretty solid sell signal. The trend has changed. And now to kind of marry fundamental analysis and technical analysis together, because that's what I like to do, at least on the best trades, the most profitable trades that I have, the trend trades, longer term, you will marry the technicals and fundamentals, combine them both. And basically, maybe the correction's over in the stock market, by every metric I have, such the impulsive move, wave counts, and it's no. At best, we're going to bounce here. It could be a pretty decent bounce. It could last for a week or more, but I think there's more downside. And so going off that theory, assuming I'm correct, we're going to go down. We've already dropped, 16, 17% off the highs in the NASDAQ 100, I think. That's going to do some damage psychologically to Joe Consumer, consumer sentiment right there. In just short order, they've seen their 401k drop, depending on what they're in. Let's just call it 15 to 20%. Maybe more, because the thing is, during the end of a very strong, powerful bull run, and this one is one of the biggest on records, people pile into crap. That's evidenced by the GameStop and the Reddit group, everything they were buying, the cryptomania bubble. And so I think it's safe to assume that a lot of investors out there have been overweighted in growth stocks, technology, semiconductors, things that go up the most, but then they also fall the fastest because they're way ahead of themselves. They're extremely overbought, and more so. And whether you want to argue with me on valuation basis and all that, fine. You can. I'll give you that if you want to say that you think they're fairly valued. But what you cannot argue is you don't see a crowded rush for the exits. If everybody, generally speaking, is bullish and long the semis and big tech and all that, then that's where you get the crowded rush for the exits, because there's no one left to buy. Everyone wants out at the same time. So there were overcrowded trades, and overcrowded trades hit hard. Okay, where am I going? Well, again, lumber, if I am correct, and there's more downside in the market, you should see this drop in the equity markets, especially if there's more coming, another 10% plus. The wealth effect, it will evaporate, and has already evaporated very quickly. Those paper gains and 401ks and accounts that people have set aside to buy a house, a car, a boat, a second home, etc., those are just a good part of that just vanished. And so where I'm going is this craze in the housing market. Prices down here in South Florida are on fire, red hot. I know that's not everywhere. I know a lot of people have been moving down from up north, New York, New Jersey, selling in places with high, property taxes and lower quality living due to weather and all that, and cramped in the big cities. That was a big thing after COVID. But where I'm going is that should, at least to some extent, greater or lesser, start putting the brakes, tapping the brakes on the housing market. So therefore, the outlook for new homes and home builders, you probably see order cancellations or fewer sales. And if that happens, that's going to translate into a lower demand for lumber, right? So lumber, in its typical fashion, will probably can fall quite a bit. So I'm going to sit tight. That's what I'm trying to say, guys. Next target there is we may bounce. We do. There's resistance 1178. The lumber, it's kind of, I've learned, pick a trend. When you catch one of these turns, I like to just set your stops and let it run. Go for the big move if you think it may be coming, and I think it will be. 861.88. Call that 862. That's a likely target, as is that 984 right there. And that'll be another. That's I don't know. Up. I just moved my line. All right, I was trying to measure out for you guys. Let me just get off that. You can do the math yourself. That's another 10% drop to that next target, then about another probably 12 or more to that other additional target down there. Okay, I referenced the VIX today. We hit my first target, exceeded that. That was, I give you the screenshot from this video right down here. This is the January 18th market analysis trade ideas. In that I covered the VIX and other things and VXX, and that's where we're up that about 30%, I think it is, from where we were there. Above the first target. Just one quick note, I think I mentioned it in the comment section there, when you're trading the VIX, I give you targets. Those are rough estimates. I always use the index support and resistance target levels to time my entries, especially my exits on the VIX. In other words, we overshot T1 today, but at that very point, the VIX reverses right about when the markets hit the bottom, hit the lows. And so if you expect a bounce in the QQQ and SPY, a tradable bounce, it only makes sense that the VIX is going to pull back when that happens. So therefore, I was able to take some profits on that, on the VXX trade, and I'll recycle back in if it pulls back, if we get my bounce targets on the indexes. All right, next up here is lumber. Again, this was the chart back on January 18th, covered in the video. I know it's a little hard to see here, but you have these are the drawings that were already there in the video. I just paused the video here. You had a steep uptrend line right there and a negative divergence. I was pointing out, instead of sell signal coming a break of that uptrend line. It's the same uptrend line I just showed you on the 60 or 120 minute chart. And I said, when it breaks based on this, that's probably where we're coming down to. So that's why on this chart, you can see when the trend changes, it's especially when volatility is high, that's it. So I'm going to press this one a little harder. I'm not even going to try to game a counter trend bounce. That's just me, but stops will be in place to at least assure a profitable trade on that one. Okay, and here's the chart today. Remember, this is from this particular chart is from stockcharts.com. They only give you end-of-day data, EOD. So we're down lower. We're already back to, this is that same wedge. I can't zoom these charts. Unfortunately, they're kind of antiquated stock charts platform, but there's certain reasons I keep a subscription there. But there's that same uptrend line right there. Forget the arrow part. Just look at the line. There's the wedge that I drew, and there's the breakdown. You can see it's just been, this is a zoom, a thumbnail. So this is from the breakdown here. You can see it's just been a straight shot down, and that's that level we may come back to, down around 800 before all said and done. Remember, this move up off the lows here was a 61.8% Fibonacci retracement of the entire previous move down, which ended with that bullish falling wedge, which was highlighted at the time. And before that, I had highlighted the parabolic run and talked about how these parabolic runs in lumber usually end in pain, and that was the case back then. Natural gas, just to update it, I don't have a strong opinion on it at this point in time. We're kind of bounced off that support there. Had that pretty big resistance there, and I don't see enough on the indicators to really make me want to be long or short at this point in time. Just want to do an update because I've covered that one quite a bit recently. Gold, still longer term bullish on gold. Intermediate, it's had a pretty heck of a run. Got a little overbought here. Had some divergence. Does have some divergence right there. If you look, we had a divergent high right here. I pointed out. We corrected. That divergence got a little bit larger. Not a great uptrend line. You can maybe draw a trend line like that, but here's the thing. Remember, this is the bigger picture. Gold's pushing that 1840-ish level right there. Big resistance, pretty much, other than this little whipsaw false breakout divergent high period right there. That's what's capped all these moves. So if gold can power on through there, that's going to be bullish, and if so, it can take out those divergences. That's the way I'm leaning. Again, the Fed has overstimulated this market, pumped tremendous amounts of liquidity. My theory, well, besides the longer term charts being constructive and the fundamentals that I've made the case for, that you've got all other commodities just going crazy in the last couple of years, rallying strong, solidly in bull markets, and I think gold's been punished, so to speak, for two things. People wrote it off for dead. It's been, a flight to safety, even store of currency for thousands of years, and yet all of a sudden, oh, crypto's here, Bitcoin, gold doesn't have a purpose anymore. False, my belief right there. And the other thing is, it is forget about the flight to safety aspect that it often, not always, but often has during market corrections. It's also an industrial metal, and I think that's the part people seem to forget about that hasn't been priced in with copper, palladium, platinum, all these things, going up crazy high. And gold and silver have those industrial applications. We're in an inflationary environment. They're metals. They're both first and foremost precious, but also industrial metals. They have industrial applications. So, anywho, and again, it either works, plays out, or it doesn't. So you don't put all your money in gold. You don't put it all in silver. It's just a piece of the pie. Right now, just to give you my near-term amount, we need to punch through there. That's what I want to see to make a case to add to gold, is a solid punch above there, 1840, and ideally to take out those divergences. Silver, I'm just going over the futures now, guys, to keep this video short. You can buy GLD or careful with the miners when you're in meltdown mode in the market. Sometimes they come under pressure because they're individual equities. There's a trend line I need to give you for silver right there. Silver futures SI off the lows right there, which we're just coming up on. So yeah, and then price support. I'm going to add one more line here that I see that should be here for support right about there. I did that line because that gets this reaction high, this one, a couple reactions there, through there, reactions there. There's a little bull flagging action right there after that flagpole, and so boom, it's coming up on support. You can, you could take a shot at adding to silver here if you wanted to get in and not, and you have an uptrend line right there, and you can, you can keep it tight, stop below. Bigger picture, it needs to just keep above this 2148-ish level there, and also needs to take out the recent highs. There's a downtrend line I gave you on the daily charts of silver and gold as well. Those guys, they both need to. So that's it. Gold and silver just have a little more work to do to the upside. And again, you can't see what's on the daily chart here. This is only a 2-hour chart. If so, they're going to break out of some trend lines and multi-year high level, what I call bull market consolidation. So that's it. Near term, a little fuzzy, but I'd rather be long than short at this point in time. On a final note for gold and silver, like the equity markets, expect some volatility this week, especially come Wednesday afternoon, because that's the big FOMC meeting. Again, it's the markets are going to parse through what Powell says afterwards, what they think the Fed's going to do. They're going to get more visibility on the dot plot, which is the projected course of rate hikes, how much and how often and when. And so you're going to see volatility, and that volatility, by the way, will also translate into most certainly into currencies, because nothing is impacted more than the U.S. dollar, and of course the euro, which is basically an inverse to the dollar because it's the biggest component of the dollar index. So the euro has pulled back to that uptrend line I gave you. We've been walking up since we broke above the bullish falling wedge back there. Been moving up, kind of choppy action. We broke out right there, ran up, hit my 1495 target, put in divergent high and pulled back, and we're back at the trend line. The single most important thing to me right now is this line here. I have a bullish falling wedge pattern here on the 60-minute chart here of the euro, which would correlate into a bearish rising wedge in the dollar. And so this, if it plays out and looks pretty clean, would be indicative of the markets interpreting whatever the Fed does as dovish. Powell. The one thing I can tell you about Powell and the Fed, even before him, Yellen when she was running the show, is this Fed is the stock market's their baby. And when their baby cries, and I've seen it, they did it back in 2018, they started trying to get hawkish, and the market threw a hissy fit, and the Fed pulled a 180. I called it in advance, and that's right what they did. They went from being hawkish right back to dovish because the market had a big drop, 20-something percent, the fourth quarter of 2018. They've stayed dovish since and only started to recently, just like then, kind of swing around in the other direction. So where I'm going is if what Powell says or does, what the Fed says or does, if it's interpreted as any less hawkish or more dovish than the market expects them to be, now that we've seen the market throw another hissy fit, then that should be bullish for the euro because it would be bearish for the dollar, right? Rising rates in the U.S. will strengthen the dollar. Lower rates or the expectation of lower or just a change in expectations would be bearish. So that's it. So this is what you want to see. The takeaway is gold and silver tend to move. They're positively correlated. So you want to see a breakout above this wedge. Oh, and then I'll leave it at this. If it breaks out today, tomorrow, be careful because anything that happens before the FOMC announcement, and even right after it, is probably noise. The odds for a whipsaw, in other words, are very high. You want to be safe. You want to see this breakout stick after the FOMC meeting, that entire day and the next, so into Thursday, because again, that the FOMC meeting takes precedence to anything that happens technically on the charts, because that's one case where the fundamentals can and often do overwhelm the technicals. But this is sort of indicative of that's where the market thinks things are going to go. Dollar down and euro up after the meeting, and that should be gold and silver up as well. So all right, I'm going to wrap it up there. There's probably other things I could cover, but I don't want this video to go for 45 minutes. Here's a quick look at the 5-minute chart if you're actively trading, QQQ 5-minute. Nice divergent low. There's divergence on the PPO histogram, divergence on the PPO itself. I'm sure if I put up the RSI here, which I could do, same thing, positive divergence on the RSI, and so we took that out. You had a little wedge on the 5-minute chart. There's the gap right there. Again, target would be anywhere from the bottom of the gap. You look at these reaction highs. That's what the market's going to look at. There's the bottom of the gap. Technically, it's right there where we gapped down to, but you have the highs right there, today's highs, and then the top of the gap, which is where we closed Friday. So that's still, I think, a likely bounce target. And again, from the lows today, which correlated with that bottom of the first target zone on the QQQ daily chart, that would give you about a 4.75% bounce. That should also most likely take the S&P 500 up. Let's see what 4.5% off today's lows would do. 4.3 would take you back to the 200-day exponential average, and 5% would take you back to the 200-day simple average. So there it is. There's your targets. There's where I think we're going, and I think it'll look something like that, give or take, followed by another leg down. This has been Randy Finney with Right Side of the Chart. Have a great day.